Hi, you're listening to Market Matters, our market series here on J.P. Morgan's Making Sense podcast. I am Montserrat Serra-Janer, Global Head of Private Market Sales for J.P. Morgan. Today I'm joined by Afrim Zeka, Head of Product at Fusion J.P. Morgan. And we're here to discuss the evolution and the trends in the private market space. Afrim, thanks so much for being in the podcast today with me.
Hi, thanks for having me.
Before we get started, I would like to give a quick intro of what we're seeing in the private market space. So what we have been seeing for the past 5 years is a shift in strategies and a shift on what we originally looked at private markets, especially from a private equity perspective. So in the past, what we were looking at was more like a cookie cutter strategy where you would have very much defined GPs, general partners, looking to investments from different type of strategies. You could have credit funds, infrastructure, private equity, venture capital. What we are now seeing in the market is this hybrid approach where different type of strategies are being applied for what originally was a cookie cutter or like an original strategy. One of the trends that we're seeing right now is, of course, everybody is looking for alpha. And for that race to alpha, the asset owners, asset managers, alternatives, and the typical general partners are merging together. They're all looking for alpha, of course, but they're also looking for different ways to get LP. That means investments and investors' money. So trends that we're seeing in the European side are more the LTAFs and LTIFs, which are retail funds dedicated to gather that LP money from a retail perspective. And also the same applies to the tender offers or registered investment companies, interval funds here in the US. So a big trend on the retail space. Another trend that we're seeing is on the secondary side. Secondaries where infrastructures, credit funds are now looking into buying and selling stakes of partnerships or stake of portfolio companies. Which comes to a question that I have now for you. As we're seeing this evolution of what used to be very differentiated strategies from a liquid and an illiquid perspective, now everything is merging. So what are the pain points, in your opinion, of what's happening from a data management perspective? Because these managers or evolving new managers, they need to have access to data. So how do you view that?
Absolutely. We're seeing a lot of trends within the data management space that go right along with what you mentioned there. Certainly, when you're looking at mixing public and private assets, there are many challenges that come into place, usually centralized around three main points. The first is being able to access all of those disparate data sets and getting them into one place. Once you get your data there, the next challenge is really getting all of your identifiers lined up. So one data provider may have an ID, another has a different identifier, but having some sort of process that can line up those IDs usually is a challenge and a pain point that we're hearing across the board from many different providers or many different servicers. The third part is being able to get your data into a common data model. By having your data in a common data model, it starts to look and feel the same regardless of where it came from. And without it, it becomes very difficult to manage those assets. And maybe bringing that back to something that you mentioned, you hit on LTAFs, and I think that stands for long-term assets.
Correct. Long-term asset funds.
Long-term asset funds. And just curious, we're kind of seeing a blend of usually they're around 20% public, 80% private. Is that typically what you're hearing?
It's a merge and that percentage is increasing. So again, I think we're going to be facing the challenges that you're mentioning from a data and a standardization of data perspective.
Absolutely. So what we've kind of observed here is that as these LTAFs are coming up online, a lot of asset managers are trying to get into the space of becoming asset owners and investing into those private equities or doing direct lending to be able to get some of those different types of cash flows. Today, they're using data management platforms that are probably geared more towards public assets, where you do have a variety of market identifiers like an ISIN, a CUSIP, a CEDAW, maybe an LEI. But when you're trying to blend that with some of those private sources, those identifiers don't exist. And perhaps those private sources are managed in different systems. So what we're often seeing as an opportunity for the technology side is how do you start creating a platform that allows you to blend those publics and privates together so that you can properly manage your book?
So we are talking about the evolution in this podcast. And of course, we're talking about the evolution of illiquid, liquid merging together. But we keep looking at the innovation as an option. And in my view, innovation should be an obligation. So as we in markets evolve into these new type of strategies, why are we still seeing spreadsheets? Why do we not evolve, to your point about data aggregation? Why do we still have to face the old spreadsheet model?
That's a great point. And I think that we hear this a lot, right? I mean, at the end of the day, everybody loves Excel. And I think at some point, it's probably fair to say that there's nothing wrong with using Excel. Some folks like to dabble in Jupyter notebooks, other ones to use Tableau, but Excel still does a great job in a lot of different ways. I think where the challenge comes in is where you've got Excel spreadsheets coming from all of your different systems of record, and you're trying to do lookups to consolidate those sheets. I think where a lot of this comes down to is having a single source of truth data model. If you can get all of your different data sets conformed into one data model where everything looks and feels the same, the idea there is you're able to then start extracting that data or pumping that data into whether it's an Excel sheet or a Jupyter notebook or a Tableau dashboard, wherever it might be. But the dashboard turns into your endpoint as opposed to having to manage all of those spreadsheets to get to your endpoint, if that makes sense.
So if I hear you correctly, spreadsheets will not go away, but they will be more for the end result. And then the data, standardization, and the solutions that you are discussing here will be before the fact, so before spreadsheets, correct?
Absolutely. So an end user may decide to use any number of different technologies to be able to analyze their data or to be able to manipulate their data to find that alpha. The challenge that we need to try to demystify is getting your data into a place where it's usable and that you can actually start drilling into it and using it. And that's where I think coming up with standard approaches to normalizing your data, enriching with identifiers, and modeling it into a common data model really takes away all of that pain and gets it into a usable form.
But then related to that, there might be some pressures to have more efficient data processing. So how do we go through that? How do we find the technology solutions for the data aggregation?
Definitely. So there's two kinds of, I think, challenges you have here from the aggregation perspective. One is you may have some kinds of data sets that are coming in a structured way. So the data is already in some sort of tabular format. It's got columns and rows. And those kind of data sets can be sucked into a normalization process and conformed and harmonized into a common data model. But you have a lot of data sets in the private space, like think about credit agreements or side letters, LP agreements. And these types of documents are unstructured. So these are more of paragraphs and words that need to go through some sort of extraction process. And what we're seeing is that there's a lot of great vendors on the street that can take that unstructured data and put it into a structured form.
Do you have any examples?
Yeah. So, for example, in capital calls, we here in J.P. Morgan have partnered with Canoe to take capital calls that are unstructured, put them in a tabular format that can then be conformed to that standard data model. Here in J.P. Morgan, we also have Omni, which is doing something similar, but more from an LP statement perspective.
So mixing the private data and the public data, I would assume that it generates a lot of reports and a lot of thresholds to overcome. But to what you just mentioned, this goes beyond just data from a numbers perspective. This goes into moving into an efficiency for the LPAs, the capital calls, for things that in the past have been manual and very inefficient. Is that an assumption?
I think it's more of a reality.
Okay.
When an asset manager or an asset owner wants to bring on more data, often that means more spreadsheets and that means more people, and that becomes unscalable. So at some point, it's really important to think about what your data management strategy looks like and how to put those foundational building blocks in place so that you can scale. We've also heard from a lot of folks that they're limited in terms of the amount of investment opportunities they can take or being able to get into certain private equity deals or direct lending because their data management platform or their market data management platform is unable to scale with them. So they're ready to invest in new types of assets. They want to build an LTAF portfolio, but they can't because their data management technology is not up to snuff.
So it's almost like a chain reaction because once the data gets resolved, do you think that then the next thing will be investors' behavior? How can we use a standardization of data to not predict, but understand where the investors' appetite is and for what type of strategies?
For sure. It's really interesting that you mentioned that because it's almost like once you get your data into a single source of truth, really, and you've figured out how to normalize it all, that then starts opening a lot of doors for you. Imagine if you wanted to be able to put a co-pilot on your team's desk to be able to say, hey, tell me all of the assets within my portfolio that had a net loss this past quarter.
Mm-hmm.
Application on top of data that's already been conformed to a single source of truth, and really that has a strong dictionary, data model, and all the metadata that supports it behind the scenes. So when you start thinking about those opportunities that can emerge, by structuring that data and taking that time to go through that journey, it almost unlocks those doors for you because then it allows you to use technology maybe that you can't use today.
So you mentioned before this concept of single source of truth. And how is that related to the data aggregation, the use of cloud-based data aggregation? But I'm not clear what that really means. Can you expand on that, please?
Yeah, that's a great point. And, you're not alone with that. We talk to CTOs and data officers all over, and it can mean a lot of different things to a lot of different people. The way that we define it, and the way that I like to think about it, is that this is often what's referred to as your semantic model. And within your semantic model, you really need three important elements to get your data into the single source of truth. The first is you need a strong data model. So you have to understand the relationship between an instrument and a company and even something like a holding or a transaction. The second thing is you need to have a strong data dictionary. So meaning when you have this single data model, you want to have an exhaustive list of attributes, but also those attributes can't be duplicative. Because if they're duplicative, then you don't know which one to use. And going along with that, you have to have a very robust definition for that attribute so that you can look at that field, or even better, an LLM may look at that field and understand exactly what that field is telling you. And the third piece is you have to have all the data, or what we would refer to as metadata, behind the scenes that helps you understand how the data comes together. And that needs to be stored in an organized way. And if you have all three of those components in your single source of truth, well, that then starts to unlock doors and capabilities that we can often dream of today, but that become a reality if done correctly.
But then if I don't have one of those three elements, then my single source of truth becomes irrelevant.
Yes, I wouldn't go as far as saying irrelevant, but it's incomplete. And often what we're hearing is that getting that complete single source of truth with all of those components properly structured is really hard because you have to have not only the human talent to do it, but also the technology capabilities as well. So if you think about creating that dictionary and that data model, you've got to have talent and people that understand everything from not only the listed assets, but credit and private equity and real estate infrastructure, all of these things. And it's very difficult to find that human talent all in one place. That's one thing we're very fortunate of here in JP Morgan. We've got experts across the board that are able to come together and define those types of models.
So a general partner or an asset manager cannot create a dictionary on their own. Like they would have to use a tool or someone like Fusion.
Well, I wouldn't want to go as far as saying they cannot do it. Certainly, anything's possible with the right level of resourcing and talent. But we often hear is that there's a number of different ways they try to solve the problem. One is they go to a very rigid, financial-focused provider that offers a very rigid standard data model that they have to conform to. The benefit there is it's already defined for you, but the downside is that data model is not very expandable. For example, they want to add an attribute or additional fields that maybe reflect their view of the world, it becomes very difficult when you have a very rigid model. On the other side of the spectrum, you've got data management providers that offer high levels of flexibility, but that means that the GP or the asset owner needs to come in and they have to define that model on their own, meaning that they're taking on a lot of that burden, which becomes very time-consuming and expensive.
So why Fusion? Why is it so unique? Tell us more about the uniqueness of Fusion.
So in Fusion, we've tried to take this middle-of-the-road approach where we've defined a data model, but we've also added a number of tools to allow users to expand that model using no code. So for instance, we've got fields already in our data model to describe your investment size and the expiration date and all of the other things that you need to be able to define an instrument. But perhaps you wanted to take a particular field and divide it by another field to create your own calculated attribute. Well, in Fusion, we've created ways that you can do that without having to write any code. So it's using all user interface tools. So any business analyst or any front-end user can easily configure that field, save it to their model, and then start using it immediately in their analytics. And that's very different from having to go to an engineer, defining what the field should look like, writing out the code, waiting a couple of months for that to go into production, and then finally getting your field months later.
So what is J.P. Morgan doing? We've been talking about a lot of trends and technology, but what is the specifics for Fusion and the future?
Definitely. Well, within Fusion, we set off to create a data management platform to not only solve our internal challenges, but also help our clients in this space be able to scale. We have fully acknowledged that a lot of J.P. Morgan clients are very sophisticated and have already started out developing their own data management platforms. So we want to be able to help our clients in any way possible, while also still allowing them to grow and take advantage of whatever technology that they've developed on their end. So that means that we're offering services to help our clients with getting all their data in one place with cloud connectivity. And that means that perhaps taking data that they're getting from J.P. Morgan or from other vendors and sending that out to Snowflake or Databricks or BigQuery or any of these other applications that are required to help them with their data journey. The second thing that we're doing here is normalizing data for our clients, getting all the IDs aligned, modeling that data to a single source of truth, and then generating pre-canned analytics to help gain those insights.
Is Fusion global and agnostic as well?
Indeed, it is. So within Fusion, we've developed a vendor-agnostic cloud-based platform. So we'll work with any vendor, any servicer on behalf of our clients to help them with getting that data into one place and helping them on that data management journey.
So what is the future for J.P. Morgan and technology, in your view?
So within J.P. Morgan, it's very hard to say where technology will be many months or years down the line. But I do think it's fair to say that we're seeing a massive trend towards being able to make data LLM ready and get data into the place where you can really start taking advantage of these very sophisticated types of AI technology that we're seeing all over the news. And what we're really trying to do is think about how do we help our clients also take advantage of the things that we're developing internally and apply that to their data as well.
Thank you so much. I mean, I think that we have spoken in this episode about private markets, public markets, illiquid, liquid, how technology can help the European versus the US trends going into the same direction, as well as the pressures that we have received and that we're facing and overcoming together from a technology perspective. This has been extremely insightful. Thank you so much for stepping by today.
Yeah, this was a lot of fun. Thank you for having me.
And thank you to all of our listeners for tuning into Market Matters on J.P. Morgan's Making Sense podcast. We hope you join us again next time.
Thanks for listening to Market Matters. If you've enjoyed this conversation, we hope you'll review, rate, and subscribe to J.P. Morgan's Making Sense to stay on top of the latest industry news and trends. Available on Apple Podcasts, Spotify, Google Podcasts, and YouTube. The views expressed in this podcast may not necessarily reflect the views of J.P. Morgan Chase & Co. and its affiliates, together J.P. Morgan, They are not the product of J.P. Morgan's research department and do not constitute a recommendation, advice, or an offer or a solicitation to buy or sell any security or financial instrument. This podcast is intended for institutional and professional investors only and is not intended for retail investor use. It is provided for information purposes only. Referenced products and services in this podcast may not be suitable for you and may not be available in all jurisdictions. J.P. Morgan may make markets and trade as principal in securities and other asset classes and financial products that may have been discussed. For additional disclaimers and regulatory disclosures, please visit www.jpmorgan.com/disclosures/sales and trading disclaimer. For the avoidance of doubt, opinions expressed by any external speakers are the personal views of those speakers and do not represent the views of J.P. Morgan.